You know, I've had the good fortune to sit with this investing game for more than a few decades now, long enough to see the patterns repeat, the mistakes pile up, and the quiet rewards come to those who stay the course without fuss. If you're just starting out as a beginner, not chasing lottery tickets or headlines, but aiming to build something real and lasting, like owning pieces of solid businesses that chug along year after year, then ease into that chair beside me. Today, we're going to talk about investing in a way that doesn't require luck or genius, but patience, understanding, and the right temperament. I'll tell you what I've learned watching wealth grow slowly at first, then all at once. I'll tell you what investors keep doing wrong. And I'll tell you the lessons that separate those who build lifelong wealth from those who get eaten alive by fear, greed, and impatience. If you're willing to listen, I promise you this will save you years of frustration. Here's the hook. Almost everything beginners think they know about investing is wrong. Not a little wrong. Completely, fundamentally, upside down wrong. They think investing is about predicting the future. They think it's about timing the market. They think it's about jumping into whatever stock is trending on social media that week. They think it's about flashy gains and quick profits. But the truth? True investing is about none of that. Real investing is about buying pieces of real businesses, businesses with durable advantages, sensible management, and the ability to grow earnings over long periods of time. You don't need 50 of them. You just need a few. But you need to understand them well enough that when the market throws a tantrum, you don't join the panic and sell your future for pennies. You see, when I started out, I didn't have a roadmap, and most of what I observed around me was speculation dressed up as expertise, people chasing tips, people whispering about insider information, people thinking they were smarter than the market, right before the market taught them a painful lesson. I learned early that if you want to succeed, you absolutely must ignore the noise. You must avoid the crowd when the crowd loses its mind, and trust your own analysis when everything around you feels uncertain. The stock market doesn't reward brilliance, only discipline. Let me put this simply. If you're investing for the first time, your goal is not to beat the market next week. Your goal is to avoid being one of the thousands of people who get chewed up by it every year. And the easiest way to avoid becoming one of those casualties is to understand what investing truly is and what it is not. Investing is not gambling. It is not a prediction contest. It is not entertainment. If your heart is racing, you are not investing. You are speculating. If you are checking your portfolio every hour, you are not investing, you are betting. Real investing is calm. Real investing is boring. Real investing is methodical. And ironically, the more boring your investing feels, the more exciting your wealth becomes over time. Let's start with a fundamental truth. The market will always fluctuate. It will rise, fall, shock you, confuse you, frustrate you, and reveal things you thought impossible. But the market's moods don't matter nearly as much as people think. What matters is the underlying businesses behind the ticker symbols. What you're buying isn't just a stock. You're buying a slice of a business that sells products, serves customers, generates profits, and reinvests those profits to make more profits. That's it. That is the engine of wealth. The entire miracle of compounding returns comes from that simple process. But beginners don't see that. They see a number on a screen going up and down, and they let that number control their emotions. They buy because it went up. They sell because it went down. They follow charts like fortune tellers. They chase predictions like gamblers. And then they wonder why they end up broke, while long-term investors quietly build wealth. Let me tell you something that will give you an enormous advantage. You don't have to be smarter than everyone else. You just have to avoid doing the dumb things that everyone else is doing. Most people don't lose money because the market is unfair. They lose money because they behave poorly. They overestimate their knowledge. They underestimate risks. They forget that investing is a long-distance marathon, not a sprint. I've seen people destroy perfectly good portfolios with terrible decisions driven by emotion. So here is your first lesson. Temperament matters far more than intelligence. I'd rather invest with someone who has a calm temperament and average IQ than someone who is brilliant but emotional. Emotional investors buy high and sell low. Rational investors buy low and hold high. Simple as that. Now, let's talk about something that most beginners misunderstand deeply: compounding. I call it the eighth wonder of the world. It is slow at first. It feels invisible. It feels like nothing is happening. But as the years pass, it becomes an unstoppable force. The problem is that most beginners never allow compounding enough time to work. They pull their money out when the market dips. They switch strategies every 6 months. They chase hot stocks. They get bored. They get distracted. They sabotage their own returns by never letting anything grow long enough to bear fruit. Think of compounding like planting a tree. In the first 2 years, you see only a few leaves. In the first 5 years, it's still small and unimpressive. But give it 10 years, 20 years, 30 years, and suddenly that little tree you planted becomes a towering oak that can weather any storm and provide shade, safety, and stability. That's how compounding works. The last 10 years of compounding matter far more than the first 10. But you don't get the last 10 without surviving the first 10. And now, let's talk strategy. Most beginners want a list of stocks to buy. They think if they could just find the right stock, everything else would fall into place. But investing isn't about finding the right stock, it's about having the right framework. Without a framework, even the best stock in the world won't save you from bad decisions. With a strong framework, even good but not amazing stocks can build incredible wealth. A good framework starts with understanding 3 things. The business itself. What does it sell? How does it make money? Is its advantage durable? The management. Are they honest? Do they reinvest wisely? Do they avoid unnecessary risk? The price. Are you paying a fair price for future earnings or an inflated price driven by hype? Most people skip the first 2 and obsess over the third. That's a mistake. A great business bought at a fair price is far better than a fair business bought at a great price. When you find a company that consistently earns more year after year, that has a competitive advantage like brand strength, network effects, patents, cost leadership, you don't need to trade it. You just need to own it and be patient. Let me share something else. The biggest risk for beginners is not market crashes. It is themselves. They think they can handle downturns until they experience one. They think they'll buy the dip until the dip keeps dipping. They think they'll stay calm until the news headlines scream panic. The reason most people fail at investing isn't lack of knowledge, it's lack of emotional control. To survive and thrive as an investor, you must accept volatility as the price you pay for long-term returns. When the market drops 20%, beginners panic. Experienced investors see opportunity. When prices fall, you are being offered future returns at a discount. But most beginners, because they don't understand the businesses they own, interpret falling prices as danger instead of value. That's why knowledge matters. If you understand what you own, you don't fear temporary declines. You expect them. You welcome them. Let me tell you another crucial truth. You don't need to understand everything. You just need to stay within your circle of competence. That means investing only in businesses you can explain in simple terms. If you cannot describe how a company makes money in 1 or 2 sentences, you have no business owning it. Complexity is the enemy of good investing. The more complicated something is, the more likely it is you are missing something important. I've watched investors chase complicated business models because they sound impressive, only to discover later that they didn't understand the risks until it was too late. Meanwhile, simple, boring companies like consumer goods, insurance, railroads, payment processors quietly compounded wealth. The stock market rewards simplicity. The world is complicated enough your investing shouldn't be. And speaking of rewards, here's something else beginners rarely appreciate. The market is a voting machine in the short term, but a weighing machine in the long term. In the short term, stock prices are moved by emotions, rumors, headlines, excitement, fear, and speculation. But in the long term, stock prices always follow the earnings of the underlying business. Always. This is why short-term predictions are useless. You cannot predict short-term price movements any more than you can predict the exact path of a feather in a windstorm. But you can analyze long-term earnings with rational thinking. If a company consistently increases earnings, cash flow, and market share, the stock price will eventually reflect that growth. It may take time, it may take years, but it always happens. That is the North Star of investing, earnings growth over time. Now, let's address another trap beginners fall into, trying to get rich quickly. They want a shortcut. They want a secret. They want a fast lane. But wealth built quickly is wealth that disappears quickly. Wealth built steadily is wealth that lasts. I've seen people strike it rich overnight and lose everything within a few months because they never built the discipline required to handle money. Slow money teaches discipline. Quick money teaches nothing. The truth is that anyone can get rich by investing, but almost nobody can get rich quickly by investing. And those who try often end up poorer than when they started. As a beginner, your focus must be on staying in the game long enough to let compounding work its magic. Now, let's talk about risk. Most beginners misunderstand risk entirely. They think risk is volatility, prices going up and down. But volatility isn't risk, it's opportunity. Real risk is permanent loss of capital. Risk is buying a business you don't understand. Risk is paying too high a price. Risk is letting your emotions make decisions for you. Risk is ignoring the fundamentals. Risk is trying to predict the unpredictable. The way you manage risk is by investing with a margin of safety. That means buying businesses when their prices are below their intrinsic value, not because the market says they're cheap, but because your own analysis tells you they are worth more than they are selling for. That difference between price and value is your protection against uncertainty. Even the best analysis can't predict the future perfectly, so the margin of safety gives you room for error. Let's also be clear. You will make mistakes. Every investor makes mistakes. What matters is not avoiding mistakes entirely. That's impossible. What matters is learning from them and not repeating the same mistakes over and over. A mistake made once is education. A mistake made twice is carelessness. A mistake made 3 times is incompetence. Now let's talk about diversification. Beginners either over-diversify or under-diversify. They either own hundreds of stocks, which they can't possibly understand, or they bet everything on one stock, which is reckless. Proper diversification means owning enough businesses to reduce risk, but not so many that you cannot monitor them. I've often said that diversification is protection against ignorance. If you know exactly what you're doing, you don't need 50 stocks. If you don't know exactly what you're doing, diversification protects you from disaster. For beginners, a balanced approach works best owning a handful of individual businesses you understand deeply, along with some broad, low-cost index funds to provide stability. And now, before we end this first half, I want to talk about something absolutely critical for beginners: ignoring the noise. The news cycle is designed to frighten you. Financial media is designed to provoke emotional reactions. They need drama to get attention. But drama is the enemy of smart investing. Real investing is quiet, calm, rational, predictable, repeatable. You don't need to follow market news daily. You don't need to watch financial TV. You don't need to track economic predictions. You just need to maintain your strategy and stick to your plan. That's the first half of our journey. Now that you've walked with me through the foundations, the temperament, the patience, the understanding of businesses, the nature of compounding, and the discipline required, we're going to take this journey deeper. If the first half taught you what investing is, the second half will teach you how to think like a seasoned investor when the world around you seems determined to pull you in the wrong direction. Because the truth is, even once you understand the principles, the real battle begins when the market challenges your discipline. Let me begin with something that surprises most beginners. The biggest gains you will ever earn as an investor will come from just a handful of decisions, not 100, not 50, maybe a dozen in your entire lifetime. A few key moments where your understanding, patience, and courage line up, and you seize an opportunity when everyone else is running in the opposite direction. Wealth isn't built from constant activity, it's built from selective decisiveness. The market rewards those who can wait for the right pitch. I've said it before. You don't have to swing at everything. The stock market doesn't force you to take action. It only tempts you. And most investors lose because they can't resist the temptation to do something, even when that something is harmful. But as you grow in your investing journey, you must internalize this. Inactivity is not laziness, it is discipline. If you have done your research, bought good businesses at fair prices, and the companies continue to grow, then doing nothing is the most productive decision you can make. The world is full of people doing frantic things, but very few doing sensible things. Now let's expand into something crucial: understanding market cycles. Markets don't move in straight lines. They move in waves: euphoria followed by fear, optimism followed by pessimism, boom followed by correction. For beginners, these waves feel alarming. They feel like earthquakes, shaking the foundation of your financial life. But to experienced investors, these waves are predictable, normal, and even necessary. Markets rise too high and then fall too low. It has always been this way, and it will always continue. Most people behave incorrectly during these cycles because they don't have internal anchors. During bull markets, they get greedy. They think they're geniuses. They think easy returns will continue forever. They buy overpriced assets. They borrow money they shouldn't. They assume risk they can't see. But when the tide turns, and it always turns, they panic. They realize they bought at the top. They sell at the bottom. They repeat the cycle forever. But you, if you want to be a real investor, must avoid the emotional trap of cycles. You must recognize that downturns are not punishments, they are opportunities. Every great investor in history made their best decisions when others were terrified. Remember this: pessimism creates the best buying opportunity, while optimism creates the worst. When news looks dire, valuations are often at their lowest. When news looks perfect, valuations are often dangerously high. To see clearly through the noise, you must build your own internal compass, guided not by emotions, but by rational analysis. This means learning to judge businesses based on fundamentals: earnings, cash flow, return on equity, competitive advantage, not on stock price movements or public sentiment. Let's dive deeper into competitive advantage, often referred to as a moat. A moat protects a business from competitors just as a moat protects a castle from invaders. A company with a strong moat can earn higher profits for longer periods because it is insulated from competition. There are several types of moats you should look for. Brand power. When consumers trust a brand, they stick with it. Companies like Coca-Cola, Apple, and Nike benefit from loyalty that is extremely hard to replicate. Network effects. The more people use the product, the more valuable it becomes. Think payment networks, social platforms, marketplaces. Cost advantages. Some companies can operate more efficiently than competitors due to scale, logistics, or process improvements. Regulatory barriers. Industries like utilities, telecom, or pharmaceuticals often have high barriers to entry. Intellectual property. Patents, proprietary technologies, and unique innovations protect profitability. A beginner must learn to identify moats because a company without a moat is vulnerable. It can be overtaken. It can be disrupted. But a company with a durable moat can compound wealth for decades. Owning a business with a strong moat is like owning a money machine that becomes harder and harder for competitors to break. Now, let's talk about a topic that makes people uneasy: recessions. Recessions are not rare events. They are part of the natural rhythm of the economy. A recession exposes weak businesses, punishes speculative investments, and tests every investor's resolve. But a recession is also the period when the seeds of the next bull market are planted. Prices fall, fear rises, quality businesses go on sale. If you're prepared emotionally and financially, you can turn recessions into the periods where you make the most important investments of your lifetime. But to do that, you must have cash ready. Cash is not just for emergencies, it is for opportunities. When everyone else is forced to sell, the investor with cash can buy. When others are fearful, you must remain rational. When the market offers you $1 of value for 50 cents, you must be willing to act. However, patience alone is not enough. You must have conviction, true understanding of the businesses you own. Conviction comes from research, not from hope. Hope is not a strategy. Conviction gives you emotional fortitude when markets shake. It tells you, I understand this company. I trust its leadership. I believe in its model. I know its value. With conviction, you can hold firm when prices fall. Without conviction, you will crumble at the first sign of trouble. Let me teach you something else that beginners rarely consider: the role of time horizon. Most people think they are long-term investors, but very few actually behave like long-term investors. They say they are investing for the future, but they act like they're investing for Friday afternoon. A true long-term investor views the stock market as a partner in wealth creation, not as a casino. They are not bothered by short-term declines because they know their real returns will be coming in decades, not months. Your greatest advantage as a beginner is your ability to think long-term. Institutions often cannot. Fund managers face pressure from investors, quarterly performance evaluations, and internal politics. They are forced to focus on short-term results. But individual investors are not. You are free from that pressure. You can think in years, not quarters. You can hold through volatility. You can let compounding work uninterrupted. But thinking long-term does not mean ignoring your investments. It means evaluating them through a long-term lens. Ask yourself, will this company still be relevant 10 years from now? Will its products still solve real problems? Will its competitive advantage strengthen or weaken? Will management continue making prudent decisions? If the answer is yes, then short-term fluctuations should not trouble you. Now, let's discuss valuation, a topic beginners fear but must understand. A great company is not always a great investment if you overpay. Price matters. Investing is not just about finding quality, it's about finding quality at a reasonable price. But reasonable does not mean cheap. Cheap stocks are often cheap for a reason: poor management, declining earnings, weak business models. Reasonable means the price you pay is justified by the long-term earnings you expect. To evaluate value, you don't need complicated formulas. You need common sense. Ask, how much cash will this business generate over its lifetime? And how much am I paying for it? If you pay too much for future earnings, your returns will suffer even if the business performs well. But if you pay a fair price for a great business, your returns may be extraordinary. Let's shift to something equally important: taxes and fees. Beginners often ignore these, but they quietly eat away at returns. Trading frequently triggers short-term capital gains, which are taxed at higher rates. High-fee investment products also drain your profits. The silent killer of wealth is friction, unnecessary trading, excessive fees, rushed decisions. The more you trade, the more you lose. The less you trade, the more you let compounding flourish. There's a reason I prefer long holding periods: the tax efficiency of patience. When you hold a stock for many years, you delay taxes. Meanwhile, the business continues compounding. Wealth builds quietly, tax-free, until you eventually decide to sell if you ever do. This is one of the simplest but most powerful advantages long-term investors have over short-term traders. Now let's consider the psychological traps that bring beginners down. The first is FOMO, the fear of missing out. FOMO pushes people into investments they don't understand because they see others making money. But you should never invest based on what others are doing. You invest only based on what you understand. Remember, you have no obligation to follow the crowd. The crowd is often wrong. Another psychological trap is loss aversion. People fear losses more than they value gains. This fear causes them to sell when prices fall, locking in losses instead of allowing time for recovery. But if you own good businesses, temporary declines are not losses. They are simply fluctuations. A decline becomes a loss only when you sell. Then there is overconfidence. Beginners who experience early success often believe they have a special talent. They take bigger risks. They chase aggressive strategies. They forget humility. Overconfidence has ruined more investors than bear markets ever have. You must approach investing with confidence in your strategy, but humility in your predictions. Let's go deeper into something that separates great investors from average ones: independent thinking. Most investors are influenced by the opinions of others: friends, news, social media, analysts, market commentators. But almost all of that information is noise. Great investors listen to data, facts, and logic, not to predictions or hype. They form their own opinions based on research. They are willing to be wrong alone rather than right with the crowd. Independent thinking also means being comfortable with boredom. Investing is not supposed to entertain you. If you need excitement, the stock market is the most expensive place to find it. True investors live in a world of repetition, reviewing earnings reports, reading annual letters, analyzing statements, observing management's behavior, studying competitors. It's not flashy, but it's effective. Now, let me talk about the importance of cash flow. Beginners often get distracted by stock charts, price movements, or growth stories. But behind every great business is cash, real dollars earned from real customers. Earnings can be manipulated. Revenue can be inflated. But cash flow tells the truth. Businesses that generate consistent and growing cash flow can reward shareholders in multiple ways: dividends, buybacks, reinvestment, acquisitions. Cash is the lifeblood of a company. As a beginner, pay attention to cash, not hype. Let's also address dividends. Many beginners chase high yields without understanding the underlying business. That's a mistake. A high dividend yield often signals a distressed company. Dividends should be sustainable, paid from real profits, not debt.